Hi, good evening to you all. Thank you very much for taking time out to join us on this Friday evening. We thought it best to speak to all of you and answer any questions you have. We have a bunch of questions we've already received. We'll just talk through those. Let me start by introducing we're quite privileged to have Harsha with us. Harsha is one of the sort of leading money managers, fund managers in the country. Nearly 25 years of being in the markets, either as an analyst or as an active money manager himself. He's, as they all say, overeducated. So from NIT Surathkal and then IIM Lucknow, has all the badges which you can get. I'll introduce myself. My name is Atul Shinghal. I'm the founder and CEO of Scripbox. We started this business a few years ago to see how we could help our investors sort of work or invest in these markets, given their volatility, given their choppiness, given the sort of our nervousness. And I think there can't be a more important time than now to be helping our customers to do the right thing. Towards that, we've invited Harsha to come and share his thoughts with us. Harsha has been managing the Kotak Mutual Fund for over 8 years now, nearly 8 years. His sort of flagship from our perspective is the Kotak Multi-Cap Fund, which is a fund we also recommend as part of our baskets at Scriptbox. And as a small anecdote, I'd like to say before I hand over to Harsha, and he'll introduce himself and his funds, that we first selected the Multi-Cap Fund to be part of our baskets. One of the Kotak customers actually asked us, who was a customer of Kotak Wealth Management. He said, our own guys don't recommend it. Why do you recommend it? He said, no, our numbers tell us that this is going to do phenomenally well. And we were proven absolutely right. I mean, every metric, the fund has done phenomenally well, has outperformed its benchmark every time. So both, we are very happy to be associated with Kotak. And more importantly, we're very proud of our fund selection using algorithms, completely unbiased, completely scientific. So it works. So now over to you, Harsha, to tell us a little bit about yourself, about your fund, about your philosophy. And then there's a bunch of questions which we'll go through and then open up the webinar for more questions from the audience.
Thanks, Atul. Thanks for your nice introduction. I think your support has always been there since the fund was very small in size and today's level. Incidentally, now it's the largest equity fund in the country, thanks to your support, your investor support. Just to briefly introduce everyone to what Kotak Mutual Fund is today and what is our investment philosophy. Kotak Mutual Fund is one of the largest asset management houses in the country, as many of your viewers would be aware of. We are the 6th largest asset management company. We have asset allocation of about 60% into debt funds and about 40% into equity funds. That's the current structure. We do rely on fundamental research for our investment process. Our investment team has been with us for more than I have been with our company. So most of the analysts have more than 10 years of experience doing the same sector, same businesses. Although I should say that some of the situation that has come upon us right now are unprecedented, uncharted. So to that extent, we have to draw all our experiences together and try to invest further. Our investing philosophy has been growth at a reasonable price, which means that we would have a bias towards growth businesses, but at a certain level of valuations only. We will not chase businesses at any valuation level. And similarly, we will not just get into value set of businesses, which may have a lot of intrinsic value, but just because their unlocking may not really be similar to the investment horizon of most of our investors, we have relied more on growth at reasonable price, with some proportion maybe in growth at high multiples and also in value stocks. So our fund philosophy has been simple: growth at reasonable price. Look for businesses that have consistent and steady cash flows. The companies which have a larger canvas to paint with. If there is a leadership company and the market opportunity is scalable, then we do get into those sort of businesses. And everywhere we give a lot of preference to the management bandwidth and the management governance standards, because end of the day, the business may be good. If the majority promoter is not aligned with minority shareholders, then the value creation may not happen. And end of the day, even after analyzing business and management, we need to keep an eye on valuation. So valuation becomes the final filter for all our sector calls and stock calls. So that's how we manage our funds. And these are tough times, unprecedented, uncharted territory for us as well. But until now, we have been managing relatively better than the benchmark and continue to look for opportunities in this tough scenario to make sure that over a period of time, the businesses which survive and which come back will create more wealth for our investors. I'll pause here and I'll be happy to go forward.
Thank you, Harsha. That's very reassuring. I mean, the statement we use is the people who will survive now will thrive later. And that's the strategy we follow for our own business. So some of the questions which are on top of everybody's mind is the markets have corrected quite heavily, 39% from the peak and about 22% in the past 1 month. How long is the pain? It's sort of a how long is the string kind of question, but what the investors are looking for some kind of guidance on. What is our house view on how long will this pain continue?
What I'm going to say may disappoint some of the investors. I'm sure most investors are today looking for some sort of an assurance that this is going to be very, very quick recovery and a quick upward movement from these levels. But as you know, these are really, really complex times, fluid in terms of how this is evolving. So to that extent, it is really difficult to predict a timeline or an extent of further correction, etc. But it is fair to say that this is not the new normal. One should not assume that this lockdown or the slowdown in businesses or a shutdown in businesses are going to continue forever. Yes, it is for a few weeks now, may extend for some more time, we do not know. But at this point of time, I think a focus on health for entire community is more important than running the business on a daily basis. I think we all have to be united to support that cause. And once we are out of this, the business will come back to normal. Some businesses may take a little more time than the others, but most businesses will come back and will come back to good health. The idea would be to look for those opportunities. If you simply look at the current valuations and expect things to normalize at some point of time, then there is a lot of value in the market. A month back, before COVID really hit us, the mid and small caps were the area where there was valuation attractiveness, but some of the large caps were expensive at that point of time. But today, after the recent correction, we are seeing value across categories, across capitalization ranges. It is just that the volatility may not stop, because until unless medical experts and scientists find a cure or a vaccine, or some of the other measures that are being taken, for example, social distancing or the weather patterns, some of this may help us. But today, until unless we see numbers reducing at local level as well as at global level, the volatility may persist. Having said that, that volatility itself is going to be a friend for those who can withstand that volatility and create a portfolio for the longer term. Because the same businesses are available today at 30, 40, 50% lower valuations. Yes, there has been some sort of a change. In some cases, it will take a little longer than others to revive. But I don't think businesses forever are going to be at a 50% the optimum level or 40% to the optimum level. They will come back, and that's where one can make money. And I must also say that it is easier said than done. When every day you are seeing your NAV is going down or your stock price is going down, it is difficult to keep that balance. But I think those who can maintain that, I think can really make money for themselves. And that's what happened in even 2008 global financial crisis. Although it was slightly different, where we could at least look at some businesses in the local market which were insulated from what was happening in the global scenario. Today, almost all of the businesses in the country are affected to some extent or the other. So it is little more widespread than what it was in 2008. And also at that time, it was easier to build scenarios because it was mostly because of the economic reasons or the financial markets. But today, without having a medical cure or a vaccine, it is difficult to build a scenario in terms of how exactly this will pan out. But I think we should keep our hopes on, and over a period of time, investors who continue to stick on will make money.
Thanks, Harsha. I mean, the Scriptbox house view has always been that this too shall pass. We don't know how long it will take, but this too shall pass. People who've been around have seen corrections before. We are hopeful, more importantly, that the health remains fine and we are able to, the weather is on our side, and maybe the BCG, the people who had a BCG shot. There's lots of news which is hopeful, and we are praying and we are hopeful that the health gets better and the country is safe, and then we'll correct for where we are at. The other question which we're getting asked is in the chat also, what should I do with my existing SIPs? Should I stop? Should I continue? And then the other question we get asked is this a good time to invest? So what are your views? We talk about asset allocation being important. We talk about remaining invested being important, but we'd love to know your thoughts, Harsha.
Yes, I think all prudent investors have to have asset allocation. They have to mind their overall investment pool and accordingly split it into equity, debt, etc., which have different risk reward ratios. SIPs are designed to take care of volatility. But when the market is down, especially when it is down 30-40% from the peak, obviously, if you have invested in the past, your units would show that kind of an erosion. That's where the question comes, whether it is good to do SIP or not. But I would just want some of your investors who have that mindset to just look into the January 2020 returns on a rolling 5-year basis or 10-year basis. The returns were very phenomenal, right? This is a situation where you're evaluating your portfolio health after 30-40% correction. It is only natural that you will see erosion in the values. But when you see a normal scenario, you would have also invested in valuation levels which were 30-40% lower than the maximum levels or optimum level. So to that extent, over a period of time, if you don't lose heart, if you keep investing, I again repeat, it is easier said than done when your existing portfolio is not showing returns. But that is where I think equity investors will have to focus on long term, continue the discipline of systematic investments. And if they can also invest in the current scenario, obviously the additional units will be coming at a much lower valuation than what they were getting in the last 5 years or 3 years. When the market revives, that is going to give them handsome returns. So I would say continue to stick to SIPs. In case there are financial difficulties, one cannot continue with SIPs, then at least please don't redeem from equity funds or don't get out of equity stock. These are not the valuation levels to panic. These are the levels where you need to manage your emotions and continue investing.
Thank you, Harsha. There's a question which is specific to Scriptbox, and I'll take an attempt to answer that before coming back to you. We do a annual portfolio review, and we use a lot of math to come up with our so things we can control, we control. Markets we can't control. So we did our analysis, we factored in everything that was happening, and we have recommended a couple of changes in terms of our portfolio going forward. And we recommend that people do actually, for their future SIPs and their future investments, follow those the recommended basket, because that's our view of the market. That's what we're doing ourselves personally, and we believe we'll trust the fund managers. People like Harsha see these as great opportunities to buy. So the money we deploy with them will give them the opportunity to deploy that appropriately in the businesses they believe in. Coming back to the other question is, though it's not an equity-linked question, we're getting quite a few questions around. We saw some volatility and actually some down days, even in liquid funds. What's happening with debt markets specifically? So is there a question you would like to take, Harsha? Though you manage equities more, but what's your view on the debt markets?
Especially after what RBI has announced in terms of interest rate cuts and additional liquidity measures, slowly the debt market is normalizing. I'm not saying that credit is available to all the companies that are requiring credit at this point of time, but I think slowly it is normalizing. So I think there is going to be money made even in debt markets, but one has to really look at each of the portfolios because not all debt funds are going to be similar. Just like equity funds, you will have different securities in debt funds as well. Just like equity funds, they would have taken different risk at different portfolios. Depending on what suits one, one should be looking at debt market. There are credit risk funds, there are accrual funds, there are short-term funds, there are duration funds. So different baskets. Liquid funds are the safest, or the overnight funds are the safest, where you don't get much beyond what you would get in a normal bank deposit, and you get easy liquidity at any point of time. So those are the funds which are good for investors who are looking for immediate liquidity at hand and not expect great returns. They will give you reasonable returns somewhere around the bank deposits or slightly above that.
There are a couple of questions around should I invest in direct equity? Should I invest in should I invest in mutual funds? Our answer to that is it's a very personal thing depending on your asset allocation. We strongly believe you should first have an emergency fund. These are difficult times for everybody. The emergency fund should necessarily be liquid funds, have sufficient capital put aside for a rainy day. We don't know what's going to pan out, but prepare for the worst in that and hope for the best. Once you've invested there, then you need to balance your portfolio in terms of immediate needs and your long-term needs. The appropriate asset allocation is important, and obviously we've got the expert in equities here. Another question we've seen, Harsha, which I'd like to throw to you. What's your sense of the firepower the government has? Like we saw a much larger action, both the fiscal stimulus and a monetary stimulus. What's your sense of the firepower the government has at this point in time for a revival?
I think one of the best scenarios for India has been the way the commodity markets are behaving. Even before COVID-19 hit us, the commodities were quite weak. India being deficient in commodities, if you have lower price range for commodities, especially crude oil, that helps our import bill as well as our overall space for some of the monetary and fiscal measures. And now, because of glut in the crude oil market, we have seen crude oil dropping from $60 to a barrel level to somewhere around $20 to a barrel. And again, it has moved back slightly last night. But clearly, we don't see global demand improving immediately. So to that extent, crude will remain at lower levels, which gives enormous space for our policymakers to use that money to really give boost to the economy. Already the government has increased excise duty on the crude oil. The end consumer is not really getting the price that he should be getting based on the import parity, but he's paying a little bit more. And that money is actually going into fill the gap that will get created because of the lockdown, etc., where government revenues are also going to be lower. So to an extent, higher excise duty on petroleum products is going to bridge that gap. And another thing which is very positive is globally liquidity is very surplus. Most of the central banks are looking for easy monetary policy. Even without COVID-19, people were on easy monetary policy. Especially with COVID hit, they will continue to remain on easy monetary policy, which means our own RBI will have more room to actually go and cut interest rates. Inflation is unlikely to go up in the near term. We have already seen food inflation correcting despite some of the issues that we are seeing in the economy. And if imported inflation is not going to become a problem, then there is more room for RBI to give more monetary stimulus. So lower interest rates are likely to continue in the economy, which is positive for all the consumption as well as all the businesses that have loans on their books. The second is about the fiscal measures. What the government has announced today, announced in the recent past, I don't call it a fiscal stimulus. It is more of a relief measure, I would say. The relief measures are focused towards the kind of segment, whether it is daily wage workers or small scale industry, which have seen a lot of issues in the lockdown period. There is some amount of relief given to them, but the real fiscal stimulus is yet to be seen. Our sense is there is no point giving a fiscal stimulus when there is a lockdown. Even if there is a fiscal stimulus today, the consumer is unlikely to go to the market and start consuming from day one because there is lockdown countrywide. So I think the ideal time for more fiscal measures, which government definitely has more ammunition to, would be when markets or the economy starts to gradually move towards normalization. I think that is when there will be a push needed to industry to really come back to the old levels, and also consumers to consume and have the similar appetite for various consumption. And we need to see some of those measures coming during that period. Fingers are crossed. I think government is obviously aware of what is needed. And if that comes through over the next few weeks, that will be great.
Thanks a lot, Harsha. I mean, that's reassuring. Now, there are a few questions which are very specific to Scriptbox, and Harsha, you can please intervene and tell us. The questions are around, I've got spare capital, I don't need it for some time. Should I be investing? So I'll again answer it in based on asset allocation. Yes, if your asset allocation suggests that you can be more in equities, we had written an article in this in Eco Times, we can send you a link on that. If you feel it's an appropriate time and you've got sufficient emergency fund and debt funds, yes, we think this is a good time to buy. We have a product called a systematic transfer plan. You can put money into liquids, and over the next 4 to 6 months, systematically put that money into equity. That would be the prudent thing to do. Yes, we have changed our basket recommendation, but that only applies to your future investments. Believe me that even the past, it's not that those funds are suddenly turned bad. We've just found that for the future, there is a slightly better fund comparatively. Traditionally, all our indices, or at least our Scriptbox baskets, have performed well. So we will tell you when to exit any fund you've already invested in. We'll introduce a portfolio scan for you in about 4 to 6 weeks from now, which will help you review your portfolio and get out of what you think might not be working for you. So again, remain invested as far as possible. Harsha, I hope that answers quite a few questions which people have asked us in the chat window and the Q&A. So remain invested. If it's a lump sum, break it into 3-4 weeks or 3-4 months, whatever is your appetite and comfort. Use asset allocation. And where should I invest? Again, this is not a biased opinion. It might sound like that. We've done a lot of research on this. Our products which we recommend, which is the long-term money or the wealth edge product on the equity side and short-term money on the debt side, we believe they're the right place to invest for investors like us and you. So just get onto the Scriptbox platform, and depending on the amount and the schedule, please set it up, and that'll be the right thing to do. The question, sorry, Harsha, if you want to add to that in terms of timing the market, in terms of what to do, I'd love to hear your view.
No, timing is difficult for everyone, including the so-called experts. So I won't advise timing, because there is always a price that you pay for clarity, right? Let's assume a scenario a couple of months down the line or a couple of weeks down the line. There is a scenario where you have complete clarity in terms of how businesses are going to run, and it's a normal scenario. Then obviously the market is not going to be available at this multiple. Today, if you look at Nifty, maybe it is at 8,000, Sensex at 27,600, and similarly the stock prices are at certain levels. Once you have a clarity that lockdown is going to end, once you have a clarity that over the next few months businesses are going to normalize, then most likely the prices will move up, because then the people will start assuming and forecasting how those businesses will run over the subsequent 12 months or 24 months. But today, when you are in the middle of it, nobody knows where that beginning is going to happen. Hence, there is scare. And also, I want to draw attention to one more point, that it is not just because people are scared about businesses that they are selling stocks. There is also passive selling that is happening, because if there is a redemption in a large passive ETF, the fund manager has no option but to go and sell. And we have seen large amounts of money coming into Indian stocks through ETFs in the recent past, especially from foreign portfolio managers. And if they receive redemptions in their homeland, they are likely to sell some of these stocks without looking at valuations. They had invested in some of these stocks even when the stocks were expensive, simply because their hands were tied and they were investing into some of these. So I think two things we need to be focusing on. One, obviously, which are the businesses which are more resilient, or which are the businesses that will come back to normal in a short period of time with less friction. Two, what is the kind of flow that one can imagine in some of the stocks? Because nobody can predict who owns which stock and what level he is going to get redemptions. And depending on that, you could see some of the stocks really getting beaten. But that's where if you have additional flows in your fund, you will be able to participate. And thankfully for us, including Scriptbox and its investors, we have been receiving inflows into our standard multi-cap fund. What it allows us is to not to sell something right now if we don't intend to, but at the same time, we can invest in some of the businesses which are today available at lower valuations. Just imagine a scenario where your recommended fund also starts to get outflows. Then the fund manager has no opportunity to really look for new investment ideas, but he will keep trying to build a cash level for redemptions. So thankfully, we don't have that situation at all. We have been getting inflows, and that allows us to buy some of the businesses which we think will sustain this downturn and come out stronger, and we'll be investing in those.
Thanks, Harsha. And just to reiterate that, though we've had a very choppy market, March actually was the best month for Scriptbox in terms of inflows. So we feel very good that our customers actually have the right investment philosophy. And we've been lucky that our customers have stuck to the belief and they're here. A standard question which has been asked in many ways, and I think, is this the bottom, or where is the bottom in the shape of the recovery curve? I'll hand it to you, Harsha. I don't think there's a straight answer to this, but nobody knows. It is my answer.
There is never a definite answer on some of these. What we can say is whether these are good entry levels for investors. Yes, definitely they are good entry levels. If you're already full up on your equity allocation, you may not want to increase your allocation. In that case, please don't redeem at least, because this would be making a double whammy if you get out at these lower valuations. So I think from a valuation perspective, it's at a very attractive zone. But in terms of timelines, it's difficult to assess how long this business disruption will continue, how long this medical issue will continue. So to that extent, there will be some impact on business financials in the quarter of March 2020. Similarly, that disruption is going to cause some downturn in terms of numbers in June 2020 quarter as well. But hopefully beyond that should be a phase where gradually things will normalize. And that's where I think more money will be made. But at least these are not the valuations where one could really panic and start selling. There could be some downside, but that is what equity investors will have to unfortunately undergo every few years. And those who survive, who continue holding, at least history has shown that they have made phenomenal wealth for themselves. And hopefully that should happen as well.
So anybody who tells you that they can tell you a specific date or even a range of dates and the shape of the recovery curve is guessing. Their guess is as good as yours, so don't take it with a pinch of salt. What we can tell you is definitely we understand valuations very well. We understand what the intrinsic value of a company is, and hence what's a good time to buy and what's a good time to hold. We trust Harsha and his team very much that if they have the money to invest, they'll be buying the right companies. So if you look at any of the consumer companies, today you can't, we don't talk about specific companies, but as an example, today you can't buy Maggi for love or money. And that demand is not going to go away. People will continue to buy Maggi noodles. So stuff like that, that demand is ever going to be there. Well-run businesses will continue to survive and grow. So have the faith is the response to should I panic or not. But the other question, Harsha, is around FIIs. FIIs have pulled out a lot of money from the markets. And what are they seeing something which we're not seeing, or what's driven that, and what do we expect? Do we expect them to come back, or what's the sense about FII money?
So FII money is not a homogeneous mix. There are passive funds, there are active funds, there are India dedicated funds, global emerging market funds which invest a portion in India. There are global funds which invest even smaller fraction in India. There are sovereign funds which will not look at their position for years together. There are pension funds which will not look at not less than 10 years in a country, in a particular market. But there are also hedge funds who would trade every few minutes or every few hours. So it will be very difficult for me to judge how foreign investors will behave as a pool. Yes, what we saw in March was one of the worst periods of outflows from foreign institutional investors, much higher than what we had seen in 2008 crisis as well. Nearly $7.5 to $8 billion went out in the month of March. And to that extent, markets have also seen erosion in value. But thankfully, there is a counterbalancing weight at this point of time as compared to 2008. 2008, it was completely dominated by foreign institutional investors and there was no domestic firepower at all. But I'll be happy to share that over the last 1 year, even when domestic equities have not done greatly, we used to get on an average about $1 billion of flows thanks to SIPs and other modes of investments in Indian equities. Even in the month of March, which I shared today in CNBC interview, our flows have been quite strong at Kotak Mutual Fund. I don't have the numbers for the entire industry. Yes, there have been a couple of players who have seen some redemptions, but our guess is the number for March will not be lower than the number that we had seen in February for the industry. If that is so, then again, you are going to be somewhere around $1 billion of inflows in March. So as long as there are counterbalancing flows, I think market will still find support at lower levels. If all investors at one point of time start selling because of redemptions, etc., then obviously the pressure is going to be more on the downside. And to me, it's not looking like a possible scenario at this point of time.
Thank you very much, Harsha. I think we're nearly out of time. We've got a couple of questions on specific stock. We do not, as a policy or practice, answer those questions. We don't believe we are equipped to. We understand, at least at the Scripbox level, how to pick the right mutual funds. So we trust the professionals to do their jobs well. Our algorithms have proven to be right. We do not comment on individual stocks or individual funds. And we will not, it's just, we don't think we're equipped enough to do it in a public forum like this. Otherwise, guys, please be assured that all your questions which have not been specifically answered have been noted down. My team in the background is sort of taking down your name and we do have your email addresses. We will send back specific answers where possible, where we don't have a view. We will say that our answer is neutral. So on that note, I'll hand back to Harsha. Harsha, thank you very much. Your closing remarks at this point in time.
It was really my pleasure to interact with you and your entire Scripbox team and the investors that you have. Finally, to conclude, let me wish everyone stays safe. All of us have got more time for ourselves working from home. So spend more time with your families, stay safe, don't worry about portfolios, and we are there to manage that. Thank you so much.
Thanks, Harsha. Once again, it's been a pleasure, and it's a privilege that somebody with your sort of experience and caliber took some time out to talk to our customers. I hope it's been as useful for them as it's for us. And we'll be back again in a week. We plan to continue, and hopefully next time we'll talk to a debt fund manager to get their view. And Harsha, thank you once again for looking after our customers. It's a privilege for us. Thank you, everybody. We'll be closing the session now, and please do drop us a line or email if you've not answered your question. We'll be there to answer them for you. Thank you, everybody, and be safe and remain invested. Thank you.
Bye-bye.